Ladies and gentlemen, good day and welcome to the Q3 FY23 earnings call of MPS Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Rahul Arora, Chairman, CEO and Managing Director. Thank you, and over to you, sir.
Good morning from Winthrop, New York, and welcome to our Q3 FY23 earnings call. Today on the call I have with me our CFO, Sumit Malhotra, our Chief Delivery Officer for our India operations, Sukhwant Singh, and our Chief Revenue Officer for our e-learning business, Rajesh Jumani. Sumit will kick things off in our opening segment today by discussing our Q3 FY23 financial performance. Then Sukhwant will update us on the content business. Next, Rajesh will discuss our robust performance in the e-learning business. Finally, I will discuss how FY23 is shaping up overall. Let's get going. Over to you, Sumit.
Thanks, Rahul. We made a solid start to H2 FY23 with robust financial performance in Q3. At INR 17.28 per share, we recorded our highest quarterly EPS in our history for the second consecutive time. At INR 132.4 crores, FX-adjusted revenue were up by 18.16% against previous year, primarily driven by three factors. Number one, growth in the content business, particularly in our scholarly customers, including journals and books. Then growth in the e-learning business, standalone and in AI design. And third is more stability in the platform business. I would like to now hand it over to Sukhwant to discuss the content solution performance in this quarter.
Thank you, Sumit. Our content business serves two primary markets, education and scholarly. So revenue in the content solutions business grew by almost 10% in quarter 3 of FY23 over the same period last year. And segment profit during the same period grew by almost 44% due to the significant operating leverage available in this business. So close to 10% growth in revenue leading to a 44% expansion in the overall margins. Our journal division continued to lead the growth in the content solutions business in quarter 3 of FY23. And given the scale and highly profitable nature of this business, the scale-up also meant margins continued to improve for the content solutions business. The scholarly books business also did well in quarter 3 of FY23. The trend towards offshoring continued in our education business, which is another significant part of our content business. And the drive towards making content more accessible supported growth in the education segment. I would like to now hand it over to Rajesh Jumani to take us through the e-learning business performance in quarter 3 of FY23. Over to you, Rajesh.
Thank you, Sukhwant. The e-learning business significantly grew in Q3 FY23 due to the addition of AI design, impressive double-digit growth in standalone MPS Interactive, and continued scale-up of product revenue at Topsin. The revenue grew from a consistent flow of projects, both from our star accounts as well as new customers. We also secured a large project to build an experience center for a consortium of PSUs in India, and the project will be completed ahead of a major event in February, which is next month. While margins significantly expanded in e-learning, they have yet to reach their true potential as we strive to expand this further in Q4 of the current financial year and H1 FY24. Back to you, Rahul.
Thanks, Sukhwant and Rajesh. As Sumit shared at the top of the call, we recorded our highest quarterly EPS in our history for the second consecutive time. Quite an achievement considering how the macroeconomic environment is shaping up. We continue to be on target to beat our stated goal of 100 crores in PAT in FY23 as we shared early in 2022. As revenue grows, margins continue to expand given the significant operating leverage available in the business. As a learning and platforms business, three factors are giving us confidence. First, our content business is doing exceptionally well with our scholarly customer base. We are at an early innings of the growth story for the customer base, and growth will continue to unfold in Q4 as well as in FY24. After a steady pickup in FY23, performance will be even more impressive in the scholarly content business in FY24. Second, while we reported growth and rich margin expansion in Q3 in the e-learning business, our ambitions continue to be higher, and we will begin to be unlocked in the first half of FY24, as Rajesh pointed out. And finally, our platform business stabilized upon commencement of the third year of ownership of the Highwire business. Modest growth in Q3 over Q2 in FY23 confirmed that the transformation of Highwire is running on par with its 5-year course per the acquisition playbook. We saw a massive ROI during an impressive payback period of less than 3 years. The true growth will only unfold in the 4th and 5th years of ownership. Finally, our culture is our greatest asset. My teams are truly empowered and perform their duties with an ownership mindset. Keeping this context in mind, we had recommended an ESOP program, and the shareholders of the company have approved the Employee Stock Option Scheme 2023 on January 21st. The scheme shall be supervised by the Nomination and Remuneration Committee, including finalizing eligibility criteria, terms and conditions related to grants, vesting, and exercise of options by the employees under the scheme. The scheme shall be implemented in due course and administered by an employee welfare trust, for which a loan will be granted by the company. The shares for the scheme will be sourced through a combination of secondary acquisition and primary issue of shares. We look forward to your continued support in this exciting new growth phase of building scale for MPS. I would now like to open the call to your questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take our first question from the line of Keshav Garg from Counter Cyclical PMS. Please go ahead.
So firstly, many congratulations for on-time high profit numbers. Sir, I wanted to understand that just taking from your initial commentary, so you said that the ESOP trust will buy shares, some of the shares from the secondary market and some to primary issuance. So what is the need for primary issuance? Why can't the trust just buy shares from the secondary market so that the equity dilution can be avoided?
Correct. So the total number of shares that we've sought approval for is about 400,000 shares. And our goal, of course, is to use up to 200,000 shares from the secondary acquisition and up to 200,000 from the primary. The reason, and we don't anticipate going to primary for another couple of years. But the reason we are having to go to primary is because of study guidelines. We can only acquire a certain value for this purpose through secondary, which is based on our balance sheet is up to 200,000 shares. So it's more compliance related, nothing to do with our preference. Of course, is to maximize through secondary acquisition.
Okay, so also it is mentioned that the quantum jump in e-learning division, some part of it was due to some one-time project that we are doing for a consortium of PHU, which is expected to get concluded in this quarter. So is this a one-off revenue, some portion, and is this 37 crore quarterly run rate, is this sustainable going forward for e-learning division?
Yeah, so I would focus on the annual numbers, and the annual numbers are absolutely sustainable. In fact, they will only grow. And I've shared the guidance in the past that the e-learning business for us, it should grow at 15-20%, which is much higher than the other lines of business. And with respect to this particular project, every year, so we have we have a line of business called Experience Centers. With the exception of perhaps 1 year, for the last 4 or 5 years, we've been building experience centers every year. So it's not a one-off. It's just that it's getting executed in these 2 quarters. So in these 6 months. So we will have experience center projects every year. It will depend on the customer whether it's in Q1, Q2, Q3, or Q4. But it's a very healthy part of our business. We tend to work with either large corporates in India or with PSUs, large PSUs in India, and we've been doing that for the past 5 years under the ownership of MPS. But previously also when the Tata Group owned this e-learning division, even then this was happening. So this is a very steady business, this established business, and will continue going forward as well. In fact, so far we've been only doing this in India, this line of business, and our goal for the next few years is also to expand into additional neighboring markets within the Indian subcontinent, but also in the Middle East.
Great, sir. So, and also lastly, so it is very encouraging that the platform solution division has finally turned around and it has grown Q1Q. So henceforth, this number will continue to grow, or is this some one-off element and things are still not stabilized?
Yeah, so the one-off element is done with. In fact, if you take the one-off element out this quarter, our margins would have been at 36%, our EBITDA margins. And we expect that to carry forward into Q4 as well as next year, 36 to 40% EBITDA margin for this business. So those one-off expenses are done with, and they were absorbed entirely in Q3. With respect to revenue, we are expecting some modest growth in the platform business in FY24. So we'll hold the 46% EBITDA margin for sure. And of course, if revenue picks up even if modestly, I can go closer to 40%.
Great. And so lastly, last year we did a share buyback in February. So now January is almost over. So should shareholders expect some news on that account of buyback?
Yeah. So currently at this particular board meeting, a lot of the focus was on the ESOP scheme. I like to keep my board focused. So once now that this has been completed, at the next board meeting we will talk about redistribution of proceeds to the shareholders, which includes buyback as well as dividend or any other form of redistribution. So we'll be exploring that at the board meeting for the annual results in May, like we've done previously. And yes, absolutely, there will be some form of redistribution. What that form will be discussed at the board level.
Okay, so thank you very much in this session.
Thank you.
Thank you.
A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Rishikesh Kare, an individual investor. Please go ahead.
Yeah, you mentioned about the impairment. I see that the other expenses have increased by almost 6 crore rupees approximately. So what exactly is the exact quantum amount of that impairment? And my second question is, there has been a dramatic...
Let's answer your first if you don't mind, sir. What is the impairment you're talking about? Sorry, I missed that part.
Yeah, am I audible now?
Yeah, you're audible, but you're referring to some impairment. There's been no impairment. Could you explain what your question was?
Yeah, so there has been a spurt in other expenses from Q2 and Q3 for almost about 6 crore rupees approximately. So I would like to know the reason for that. And my second question is, there have been dramatic improvements. Yeah.
Yes, so the reason for that is outsourcing. It's primarily outsourcing. So 2 items. One is outsourcing related to the large experience center project that I described. And the second would be the one-off expenses we've had in the high wire business as we settle some cost items these are exit costs from the cost items. So these are one-off expenses. It's a combination of outsourcing and this cost that I described.
Okay. And the other question is, there have been dramatic improvements in technologies in artificial intelligence like ChatGPT, etc. So So how would that affect our business in the future? And are we taking any steps to actually leverage on that?
Excellent question. Excellent question. So any drive towards efficiency and automation for us presents a massive opportunity because it allows us to differentiate from ourselves and our competition. Remember, we operate in a highly fragmented market. There's lots of these small players at the tail, and we're always looking to kind of look for opportunities where we can differentiate ourselves and consolidate that tail. And of course, MPS tends to be at the forefront of new technology and new innovation. And machine learning and AI is no different. In fact, our R&D team based out of Bangalore, which is over 100 people strong, branded as MPS Lab, has made tremendous strides in this particular area. Specifically with machine learning, we've been applying machine learning in content production for a few years now. So it's a very well-established practice, which has allowed us to achieve turnaround times much better than our competitors, as well as it also helps with margin expansion. More recently, we've started making explorations in areas like creating supplementary content from core content, research integrity, assessing the quality of language as we get varied formats of inputs from the manuscripts, creating images, but also using AI to check how images have been possibly manipulated. So we tend to do a review of the inputs that we get, and the AI allows us to do that very quickly, as well as generating alternative text through AI for accessibility. So we have a series of initiatives. Some are operating at a pilot level where we are co-developing things with our customers. Some are operating to an emerging level where we've had a certain amount of volume go through the AI-enabled workflow, and we're trying to figure out how do we now scale up to the next level. And then there are certain areas like typesetting and composition where things are more established as well. So lots of initiatives on board. We see it as a massive opportunity for MPS because while the Chennai floods and the pandemic allowed us to differentiate ourselves in terms of a business that has resilience. This particular opportunity allows us to differentiate ourselves in terms of how quickly we can get our customers' content to market, but also how not just speed, but also the kind of the predictability of the quality. So we are totally embracing this. We have built products on top of this, and we see this as a massive opportunity to gain market share for MPS.
Okay. And one that's really great to hear. And so actually, it's not a threat; it's more like an opportunity. You are saying.
Yeah, basically, the way we're looking at it is that there are hundreds and hundreds of players in this space. Our customers obviously want to work. At some point the supply chain is going to get consolidated, and whenever you get these shocks to the system, each shock is an opportunity for organized and resilient and professional players like MPS to kind of gain market share. So this is another shock to the system, and we welcome the shock.
Okay, that's really nice to hear. And in one of the previous meetings, you had said that you would have a 40-40-30 operating margins target. So roughly that would mean that we would again touch to our all-time high of 35% operating margins in the next year. Are we still on the course to achieve that?
We're getting there, as you see. I'm not going to be sharing any guidance for next year. I have shared guidance for the end of 2027, which is going to get to 1,500 crores in revenue and similar margins. Now, whether those are 30%, 35%, those are things that will play out every quarter, every year. But the bold vision is to get to 1,500 crores top line at similar margins. And I think margin expansion continues to happen at MPS across the different lines of business.
Okay. Thanks, and congratulations on the excellent results. Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and one on your phone now. We have a question from the line of Mahesh BP, an individual investor. Please go ahead.
Hi, Rahul. Post the acquisition of EI Design, it was mentioned that they had a revenue estimate of around 6.7 million for FY23, and MPS has around 10 months of revenue contribution from EI Design. MPS e-learning had 83.5 crore revenue in FY22. So do you think with 95 crore for 9 months FY23, is there some miss in terms of the growth for EI Design?
No, there's no miss. All lines of business are growing. We're very happy with the growth that we have in the e-learning business. But we really are not seeing these as different lines of business, because this is now EI was our fastest integration. So MPS Interactive acquired EI Design, in May, June of 2022, and we integrated teams within 3 months. Our fastest, and so we are actually not even thinking of these as different lines of business. We're thinking of this as one e-learning business, and this kind of pie is growing. It's very difficult now to differentiate what is EI, what is MPSI. It's almost impossible because it's all blended in now. Same teams, same leadership, all, that kind of thing.
Okay.
It's difficult to make that kind of cut. Yeah.
Okay. My second question is, you had articulated a vision of 50 million revenue for e-learning by 2027. Are there any factors other than valuation that's holding up the deals that you're pursuing?
Nothing is being held up. We just did an acquisition in like 6-8 months ago. So nothing is getting held up. Everything is working fairly well. We have no issues on the acquisition side. I'm sorry, maybe I didn't understand your question.
No. So the 50 million revenue vision that you have for e-learning, does it still, hold up?
Yes, absolutely.
Because, any delay in acquisition will warrant a higher growth or a bigger acquisition.
What I'm not understanding what the delay you're referring to. We just did one in May or June, right? So there's no delay.
No. In the sense, in terms of the run rate that you need to get to $50 million, that's what I'm looking.
No, we are on track to based on the business plan. We're on track. I don't think in fact we are ahead of the curve.
Okay, great. That's it from my end. Thank you.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and one on your phone. We have a question from the line of Jagveer Singh from Shade Capital. Please go ahead.
So congratulations for the good set of numbers. And actually, I joined late conference. So my question is regarding the Q4. So we have achieved 31% EBITDA margin in the Q3 in this quarter. So these are sustainable, or we can see some kind of improvement in the Q4 and FY24.
I think again, normally don't provide this type of guidance, but qualitatively what I can say is I think Q4 is very similar to Q3. And the goal, of course, then very similar to Q3 in the sense that there was an outlier where we had these one-off expenses in the platform business. So platform will go back to 36%. With the exception of that one change, Q4 will be very similar to Q3. And again, like I was describing at the top of the call, the e-learning business should improve margins in the first half of FY24. So content margin should hold. Platform margin, exit margin should be close to 36% of this year. And then next year, e-learning margins should continue to improve. Our goal, of course, our next milestone is to move this from 25% to 30% on the e-learning side. So, and we're hoping that by the second half, so the first half of the year, we take all the action, and through the second half of the year, we start seeing a result of those actions. So yes, margins will only continue to improve from here.
And so any guidance for the next year on the revenue front?
Not right now. I think the vision continues, the bold vision continues to be on track to get to 1,500 crores by the end of 2027. And then, of course, once we close Q4 out, possibly, we can have this conversation when we're talking about our Q1 results of FY24.
Thanks a lot.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. Participants may please press star and 1 to ask a question. We have a follow-up question from the line of Keshav Garg from Counter Cyclical PMS. Please go ahead.
So just wanted to understand that what are you hearing from our major customers on the demand side and as well as on the pricing side?
I heard the demand side. What was the second part?
Sir, and pricing. Is there any pricing pressure? Are the customers asking us to reduce our prices?
No, I think so. On the demand side, not yet. But having said that, we have stepped up, our interactions. So, wherever we were doing quarterly meetings, we're now doing monthly meetings. We're trying to get our account managers to meet with our customers physically in person as much as possible. So we've definitely stepped up the activity in terms of being in front of our customers. So far, nothing yet on the demand side. On the pricing side, also not as much. There is a lot of conversation around improving speed to market on the content side. I was in a response to a different question. I was talking about how there's applications of machine learning and AI that enable some of that. But there's a lot of conversation around how do we go quicker to market. But there's so far not been too much conversation around demand side. On price, of course, that happens every year, where we at lower prices we get more volume. But that's been par for the course. Nothing unusual, which would happen in a recession where people would ask for price cuts without any exchange without an upside. So that, of course, price cuts do happen with the potential volume upside. Those have happened already. We are, of course, studying the macro and making sure that we are in front of our customers as much as possible. And also now that, in-person meetings are possible, we are trying to do as many physical meetings as possible, attending a lot of events as well. Nothing yet. And definitely, when we do hear something, we will report that on the earnings call.
We have our next question from the line of Rahul Jain from Dolat Capital. Please go ahead.
Hope I'm audible.
Yes, Rahul, we can hear you.
Hello.
Yeah, go ahead, Rahul. I can hear you.
Yeah. First of all, congrats on this numbers. Of course, you told about, your prospects and all, in terms of what kind of growth you see and all. But just to go a little deeper in terms of what aspect of the markets are helping you achieve this kind of growth, especially on the content side, and also what is lifting up the traction on the platform side of the business.
Sure. So, when we look at our, growth strategy, we don't think of our business as content, e-learning, and platforms. That was one big change we made a couple of years ago, and possibly, that mindset change has helped. We started to look at our customers in market segments instead of business segments. So while we report our results as content, e-learning, and platforms, when we go to the market and we fight for market share, we look at the market as scholarly, education, and corporate. And there's different approaches for each of these markets. For the scholarly market, we are following a very basic price warrior approach, where we are undercutting the competition to get more revenue and also to build more volume. In addition to that, we are following a bundling approach. So between our various, so we have a complete product ecosystem, a SaaS-based product ecosystem. So we're trying to cross-sell as much across that ecosystem. And finally, we're also trying to cross-sell across our content and platform business for the Scholarly customer base. So the market view is enabling us to sell different things to our customers across MPS versus trying to sell individual products and services. So we're looking at, like, let's say we go to university press, we try to get more volume through the price warrior approach, and then we'll try and cross-sell. So their content customer, will try and sell them a platform, or their platform customer, will try and sell them a content or enrichment platform. So that's the approach for the scholarly market, which is kind of helping us quite a bit. On the education side, there's a couple of things that we're doing. With the current customers, we are following an approach where we are taking the onshore, the US-based capabilities around content development and design, and combining that with our digital expertise that we acquired through our e-learning business. So taking our e-learning capabilities and our content capabilities and unlocking that synergy for our customer base on the education side. In addition to that, we are focusing more on immersive learning, so really learning by doing. Those solutions tend to be high-end, also tend to be more recurring in nature, as well as within the education space, we're targeting not just the publishing community, but also education institutions. So we're now directly working with community colleges, universities, and continuing education institutions. So that's on the education side. And then on the corporate side, through the acquisition of EI Design, we've kind of inherited a marketing-led approach. There's a new proprietary capability that we've acquired from EI, where basically, through their approach, we get a lot of awareness and interest into the company. And then we've always been good at converting that awareness and interest into business. So we've kind of taken the EI approach that we acquired and we're spending more dollars in there to get even more leads, and then converting that through our solid approach. In addition to that, we're expanding into newer geographies on the e-learning side. So we started doing business in India. We have new customers in Australia. So the rest of the world for the e-learning business has picked up, which is again was something that we were not attacking before. But again, EI had a very strong customer base in the rest of the world, and we've kind of been building on top of that. Again, on the corporate side, we've also been leveraging on many industry partnerships. So we have, partnerships with industry associations. We tend to be an award-winning vendor partner. We participate in all the award process. And also, we have been very picky about the industries that we go after on the corporate side. We're trying to go after industries where there's sort of heavy spending on learning and development. So again, I think the big structural change that we made is that instead of thinking of this as business lines where we're trying to sell content, platform, learning to individual customers, we're now approaching it from a customer perspective, from outside in, saying that if you're a scholarly customer, this is your business problem and this is how we can solve it. And likewise for education and corporate. And then within each of those markets, we're following different approaches that are custom to the market dynamics. So yeah, it's been a very thoughtful exercise, and it's been years in making. Of course, we're seeing the results now.
Right. And, of course, thanks for that detailed clarification. Just to add a little bit more here, if you could divide some of this incremental opportunity, of course, the capability addition, re-addition, those are a fresh perspective. But if you see from a client perspective, what is driving the traction? Is it simple market share win for us, or is it even better budget on their part, or some behavioral change in terms of how they are consuming some of this thing earlier versus, a third party? Any such flavor from a client perspective, if you could add?
Again, different things for the three markets, right? So for a scholarly customer, there's a desire to work with fewer partners, and we are one of the few partners that have both content and tech expertise. Normally, you go to a tech vendor for the platform, and you go to a content vendor for the content expertise. Here, they're able to work with us across both things. It's like having two companies in one company, or multiple companies in one company. And what it does for them is, they're trying to push more content out there, so it increases their speed to market. So that's why on the scholarly side, I think it's market share, but it's basically almost a new market that we've created. So there's a content market, there's a platform market, there's a content plus platform market that almost only MPS is operating in this third market that combines both these markets. So that's the play on the scholarly side. On the education side, again, on digital, historically, they've had different vendors for content and different for digital, and very few vendors that can provide both. So there's an element, again, similar to scholarly, that we've created a third pie. But another element to education is that we've entered an entire new market. So previously, our entire revenue from education used to come from the major educational publishers. Today, we're working with some of these new learning companies that are emerging globally. We're working with universities, we're working with colleges. So there is a market expansion that's happened on the education side for us. And then on the corporate side, the market is growing at 10-12% on its own. The pie is increasing. Of course, we're winning more market share in that expanding pie.
Right.
Mr. Jain, does that answer your question?
Yes, it does. Just last bit, if I may, which is related to, I think, Rahul, you spoke a couple of quarters back that there is more content that is now getting created post-COVID in terms of research. Is there any change to that view in terms of your observation? Is that traction continuing, slowing down, accelerating? Any way to see that?
Yeah, it's definitely continuing, and in fact, I think the customers are also becoming more thoughtful in their approach. So, for example, a lot of recent conversations are about speed. How do we push more content faster? And that shows that this is not just something that they're flirting with, but they're committed to. So earlier the conversations were more discovery. Now it's more about, okay, we know we want to do this. What's the engagement model? And what's the tech behind that engagement model that will make sure that what our vision actually kind of fructifies. So absolutely, if anything, I think we move from discovery to now implementation.
Great. Nice to hear that. Thank you so much, and best of luck for the time.
Thank you. A reminder to participants to press star and 1 to ask a question. We have our next question from the line of Naveen Bothra, an individual investor. Please go ahead.
Yeah, congratulations for good set of numbers. So my question is regarding the growth guidelines, which we are saying that by FY27, we want to be a 1,500 crore revenue company. When we see our current revenues of around 520 crores range, in the next 4 years, it entails a huge compounding growth for the next 4 years. When we see our current revenues, except e-learning, that EI design, the major growth in this year is coming through the inorganic part, EI design. So if you can throw some more light on this growth guideline, how we want to achieve organically as well as inorganically, if you can throw some more light on it.
Sure. I'll do that. And before I want to correct the data point that you shared. The e-learning business has not just grown because of the acquisition of EI Design. If we take EI Design out, the standalone e-learning business grew at 27% in Q3. Just to make sure that we're all on the same page, the standalone e-learning business for MPS without EI Design grew at 27%, which is pretty phenomenal organically. So definitely the e-learning business is growing faster than the rest of the segments. So it's not just inorganic; it's a blend of organic and inorganic. And what we envision is, as we scale from 500 to 1,500 crores, about 60% of the incremental revenue will come inorganically, and 40% will come organically. So we think we envision it's going to be a 60-40 split in the favor of inorganic as we take it from 500 to 1,500.
And the capital allocation for the 60% part, as well as the return to shareholders and all these things.
Correct.
So currently, yeah. So in what I described, Asha mentioned that. Sorry about that. what I described was the underlying assumption is that the profile of acquisitions will be in the $15 to $30 million range in revenue. And will be funded from internal accrual. So that's the current, the assumption when I talk about 500 to 1500, that's the underlying assumption on the inorganic side. Now, having said that, if suddenly we find this great opportunity, which is greater than $30 million in revenue and checks all my boxes of it's a growing company, it's EPS accretive, it's strategically enhances our capability portfolio, etc. Then we would look at even a combination of debt and equity financing. But that again we will have to detail out when the right opportunity presents itself. So far, the numbers that I'm giving to you assume we will acquire businesses in the $15 million, $30 million range and fund it from internal accrual.
Oh, thank you very much, sir.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. Participants may please press star and 1 to ask a question. We have a question from the line of Mahesh BP, an individual investor. Please go ahead.
Hi, Rahul. Will you look at inorganic growth in content vertical given that it is a very high margin business?
Yes, so we are actually looking at all verticals, but the thing that we, on content, we would do an acquisition if it does provide us something meaningful, something new that we don't have. So on the content side, as Sukhwant was describing in his opening remarks, we're focused entirely on education and scholarly. So, if there's anything out there that gets us into a third, there's lots of content has 7 or 8 different types of fields. So if something gets us into an additional field, or within education and scholarly, if there's some new capability that we do not possess, absolutely. So it has to be, from our perspective, like I described, it has to be a growing company. It has to be EPS accretive. We're not looking at rescuing sinking ships anymore. We want things to be accretive. And finally, it should add some strategic advantage where we go to the market and we say, this was us before, but now this is this plus this, and therefore, there's sort of a multiplier effect. But so it's absolutely looking at that as well. But it will have to sort of the boxes a content acquisition would need to check would obviously be far more than an e-learning acquisition or platform acquisition.
Is new logos also a factor?
No, I think so. So yes, on the e-learning side and the platform side, yes. But on the content side, I think that's a lazy approach. So just if the acquisition, all it provides us is new logos, that's not very interesting for us because that we should ideally be doing organically.
Okay. That's it. Thank you.
Thank you. We have our next question from the line of Parth Chawda, an individual investor. Please go ahead.
Yeah, good evening. First of all, congratulations on amazing sets of numbers. I've been following your company from last 2-3 years, and you said the right expectations and deliver on it. So congratulations on that. My one question is, am I audible? Hello.
Yes, you are. Thank you so much for your compliment.
Clear though. Can you use your handset, please?
Yes, a second. Yeah, so my question is, as of now, we are on 3 lines of business: platform, content, and e-learning. So is there any plan to expand the line of business through organic or inorganically?
So organically, we've kind of already expanded into one more line, which is marketing communication. So like I was explaining on the previous call in a previous question, a different context, we operate this business where we build these, large physical and virtual experience centers for many of the leading brands in India, including large corporates as well as PSUs. So that vertical is now emerging organically as a vertical called marketing communications. Currently, all of that revenue is sitting within e-learning. When it becomes material, we can potentially, currently it's not material enough for us to call it a fourth segment. If it does, we will look at that. And of course, if it's an opportunity on the acquisition side presents itself to accelerate that aspect, we will pursue that. But other than that, so currently we're looking at content, learning and platforms, and of course the fourth one is marketing communications, which we organically already invested and created. But the focus really is on these 3+1 segments that we have.
Okay. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, to ask a question, please press star and 1 on your phone. Participants may please press star and 1 to ask a question. As there are no further questions, I would now like to hand the conference over to Mr. Rahul Arora for closing comments. Over to you, sir.
Thank you, everyone, for your excellent observations and thoughtful questions. To conclude my comments, I'm delighted with our continued progress in this new phase of building scale for MPS, market-leading margins in the content business, sustainable organic and inorganic growth in the e-learning business, and untapped potentials in the platform business form a potent combination towards Vision 2027, which I have articulated previously. But I'll repeat that. My vision for MPS in 2027 is to create a compelling learning company at a meaningful scale that will help the world learn smarter. We aspire to be the provider of choice in a market that powers experiential learning experiences with the latest technology innovation. What you're seeing today is a result of the hard work and diligence and ownership mindset of me and my team over the last 5 years. Very similar to the bamboo plant, you're at it, and suddenly you start to see the results. I think we're now at the bamboo moment for MPS, where things are finally starting to fructify and grow. So thank you for all your support and patience over the years, and look forward to your continued support going forward as well.
Thank you. On behalf of MPS Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line. The conference is no longer being recorded.